Hi everyone, hope you're all doing well today. I've got 5 stock updates for you guys. So for you guys that like those videos where I talk about a lot of stocks in one video, I'll spend a minute or two on them and just give you a little update about what's going on with them. You guys will enjoy this video as always. And yeah, let's get started anyway. Hit that like button. Let's go. So first of all, PayPal. Let's talk about PayPal. I dropped a video on PayPal yesterday saying that I'm a little bit concerned in the direction that PayPal's going in at the moment. Now, what makes me laugh is that I get a great insight from when I do these videos. This is one of the great things that I like about doing YouTube is that I get a sentiment around stocks and the stock market. I get to see about 5,000 individual stock market investors' opinions on the market. And I can see when a stock is like really in the dumps and nobody wants to own it. Like if I talk about a stock and everybody's in the comment section going, it's a crap stock, I can say, okay, the sentiment's really negative on that. Maybe that could be a time to go buy it. And when I talk about a stock and I see everyone talking about it really positively, I'm like, ooh, okay, everyone's really positive on this stock now. It kind of got to the thing where people are chasing the stock. Do I need to be a little bit more careful? And I like that because I get to be, my favorite thing is when the quote about Warren Buffett that I talked about on the video, on this PayPal video, is that when everybody's being greedy, I like to be fearful. And I think that everyone's getting a little bit too excited by it. Is it near the top? When everyone's being fearful, everyone's throwing it, going, I don't want to own that. Is that a chance to go get a stock at too cheap levels? Is everybody giving up on it? And actually, sooner or later, everybody will start turning around and go, actually, that's a really good stock. And I'm going to go buy that. And PayPal's exactly that story right there. I've talked about PayPal for a long time. I've been buying the stock for a while. And everybody a year ago didn't want to own PayPal. It was a dead company, trash stock. Nobody wanted to own PayPal, and I was buying it. Now since then, I've made a lot of money on PayPal, and I'm doing really well on PayPal. Now, stock's gone up 50% year to date, and everybody's going, PayPal's the best stock ever. I want to own PayPal. Everyone's talking about PayPal in a positive way. PayPal's only going to go higher. When I did this video the other day, there were people in the comment section going, why don't you want to sell? Why are you selling PayPal? PayPal's going to go to $200. You want to keep owning PayPal. And I thought, that's a perfect example of where the market sentiment is. Everyone thinks PayPal now is going to $100, $200. But I like looking at the momentum of the stock. I like looking at the numbers of the stock. And first of all, there's a few things that I want to talk about on this video that came up when I talked about PayPal. I think I can probably find it made me laugh because I had people on the comment section saying you should read the book called The Intelligent Investor. I was like, okay, if you think I've got to a investing record like mine without reading The Intelligent Investor, okay, that's actually quite interesting there. See, another one here, PayPal will be a good compounder. I won't be selling until $250 to $300. You try to find someone saying that a year ago, there'll be no one around saying that. PayPal is still a good value for a stock. Well, when I ran the numbers the other day, I'm not too sure on that one anyway. So yeah, so the first one was this: is like you care more about the stock fundamentals. And this comment made me laugh on the video because I thought when we were running the video, I just don't understand how someone posts a comment like that one. Whoa, that was loud. I don't know how someone posted a comment like that one because the fundamentals is like the financials of the business, the valuation of the business. And I don't know how you watched yesterday's video and you saw me running the numbers on the stock. You saw me looking at the fundamentals and the fundamentals are changing because the growth's slowing down. So if the growth is slowing down, if the fundamentals are changing, are we going to have a different outcome to the stock? And that's exactly the case. I spent yesterday's video saying like the growth's slowing on the business. Like that's a change to the fundamentals of the stock, and that's making me a little bit concerned, and we've got to take that into account. I don't understand how someone yesterday went, so you care about the stock more than we spent the back end of the video talking about the fundamentals of the stock and what's changing there. And I got this comment here from someone called Danny Ho, and he said, hold on Jacob, I'm sure you will read this but probably not reply. Hey, well, you made it to the video. There you go. You put a video that PayPal has 300% upside a year ago. That's what I talked about at the start of the video. I don't know if I can scan back there. You can just see it there on the small white screen. I don't want to do that because I'll probably have about 1 million adverts thrown at me if I did click on it. But when I first started buying PayPal, I said, potentially the stock has 300% upside if it really executes to perfection. So that's what the reference was to there. And you started buying it at 50 to 60. It's currently around 90. It's gone up about 57%, and you stopped buying it. What happened to the prediction of 300% upside? Now, this comment here from Designer23 summed it up perfectly. Did you watch the video? I could not sum the reply up better than that. So I've got to kind of just repeat what I said in yesterday's video. The thing is when I did that video about 300% upside, that was best case scenario that they execute. Okay, now we're a year in and then we look at the numbers again. Now, if you go from the best case scenario from where I talked about it a year ago to where it is right now, I pretty much said on the video that the numbers have changed. The growth is slower than what I thought. So on a year ago, I thought PayPal would achieve somewhere between 5 to 15% revenue growth. At the moment, they're all the way down at like 3 or 4% revenue growth. The fundamentals have changed of the business. So the upside has come down because the fundamentals have changed. I've rerun the numbers have changed, and I've gone, okay, that's limited the upside. If you watched the video from a year ago, and I said that on that video there from a year ago, that the big thing that will help me here, and this is the big thing with stocks, is not just the fundamentals improving, you've also got to have metric expansion. So when I did that video back then, this video here, and I talked about PayPal, you would have seen that on that video I said, okay, we need the fundamentals to improve, but we need metric expansion. So we need this company to go from where it's trading at right now, which is like 14 times earnings, up to 30 times earnings. Now, at the end of the video, I even said it on that video there, I said that if the stock is doing these numbers, I don't think it can get metric expansion. I don't believe these numbers will get it to trade at 30 times earnings. So that's how you go from a stock that potentially has 100% upside to 300% upside. The fundamentals have changed. The growth has slowed down. That means the metric expansion will also slow down, and my upside has been limited, and that's why I've had to kind of change the numbers here. That's what can happen over a year. You look at a business a year down the line and you go, oh, this is getting a little bit worse, my upside's limited. It's exactly the same on the other side, okay, like a company like Hims and Hers, for example, and I look at Hims and Hers and I was buying at $3, but then I rerun the numbers, I look at the growth is only speeding up, the profitability is only scaling up faster than what I thought, and I look at Hims and Hers and I go, hold on, Hims and Hers, all that I'm seeing right now is the metrics are expanding. The profitability is going up faster than what I thought. They're going to achieve more profitability than what I thought. The growth is going faster than what I thought. So if I look at Hims and Hers, for example, and I run the numbers on Hims and Hers, I would then look at Hims and Hers and I would say, I really like it at $3, and then the stock goes up to $20, but then I'm still buying at $20. Well, why am I buying at $20? Because the fundamentals have changed from Hims and Hers. They've actually got even better than what I thought. So then I update the numbers and I go, actually, I was buying at $3, but I can justify buying at $20 because the growth's a lot better, the profitability is a lot better, the profit margin is a bit better. And that's what you got to do. You got to, keep looking at the fundamentals and see where you can go. And one big thing is the growth. And then also when you factor in the growth and the profitability and the profit margins is potentially what valuation that can trade at. If they have excellent numbers, they're going to be at a better valuation, aren't they? If you've got a company that's doing not as good numbers, it's going to be a lower valuation. And that's the two things that will factor into a share price. When you're trying to buy a stock and you want to make money on it, those are the two things that will factor into it, is the growth, the fundamentals, but also metrics. What's this stock going to trade at? Is it going to be a lower valuation, a higher valuation? Now, we as investors, it's really hard to actually predict where it will be valued at. That's the $1 million question. We don't know. I don't know where PayPal is going to be exactly valued at. But my instinct is looking at these numbers, the valuation is going to be a little lower on a metric point of view than where I first kind of expected. So yeah, and also that it's gone up 50-70%, and it's and you stop buying. Well, isn't that basics? Is that in that basics of buying something? If I wanted to buy a sofa and I think I could sell it, so if I buy a sofa for £50 and I think I can sell it for £100, okay, I'm going to buy it and I think I can sell the sofa for £100 further down the line. The sofa goes to £40. Okay, I'm getting the sofa even cheaper, and I think I can still sell it for £100. So I'm going to keep buying the sofa. I'm going to buy the sofa. I might buy more sofas. If the sofa is now £60, you know what? I can still sell it for £100. I'm still going to do it. But if the sofa has gone up now from £50 up to £80, and I think I can only sell the sofa for £100, well, I'm not going to buy the sofa, am I? Because I might make a little bit of money, but then I've got to deal with the admin, I've got to do the hassle with it, and probably, you know what's going to happen? I probably can go find another sofa out there that I can get for £50, and I can make more money on that one. So I'm going to say, you know what, I'm going to leave that one that I'm only going to make £20 on, because I think I can go find another sofa over there that's £50 that I can sell for £100. Is it? You know, I apologise for a lot of you out here. I think that's the basics of finance, isn't it? So yeah, of course I'm going to stop buying it. If I feel like the return that I have has now shrunk on the business, I'm not going to keep buying a stock at 50. If I think the stock is worth is at $50 and it's gone, and I think the upside's up to $100, obviously I'm going to stop buying it if it's now $90. So yeah, so it seems to me you prefer falling knives stocks. I don't know what the term about falling knives is. I think PayPal was a great case of averaging up. I think it was like, I think I started buying at like $70. It went to like $50. Okay, I can keep buying that one, average down, and then make more money. I won't call that a falling knife. But yeah, I don't know what you mean about calling other YouTubers about buying falling knives. I don't know. I call other YouTubers out for being scammers and promoting courses and products that are terrible. I know I do that one. I don't know. It's a weird comment. And then I got another one from this guy as well. You yourself said many times in the past to take analyst ratings with a pinch of salt. I do. But in that video there, at no point did I say about analyst price targets of a stock. If an analyst price target comes out with PayPal's worth $110, yeah, I'd ignore it, because what a lot of analysts are trying to do is 12 months down the line, they're trying to predict the current share price of the stock. So for me, as a long-term investor that's investing for 3, 4, 5 years, I don't care where analysts think the stock's going to be in 12 months' time. So yeah, I do take analyst price targets with a pinch of salt. And the other thing as well is, like, quite often analysts are following the stock price, because if the stock price is in a downtrend, quite often the analysts that are trying to predict the share price in 12 months' time are going, oh, that stock's crashing huge, I'm going to keep lowering my price target. Same if the stock starts rolling up out of nowhere, they all jump on the ship and start hiking up the price targets because they think, oh, the trend is only going to continue. So yeah, I do. And I don't understand why that comment came in yesterday. And he also said, you just say whatever suits your narrative. I mean, if you say so, but I think I've stuck with that for the last kind of 5 years, and it wasn't even mentioned on the video. But hey, sometimes, like I said, these are some of the people that I attract into the comment section, unfortunately. But I think the same guy was saying Watch of Switzerland wasn't a buy, and once again, that was a turnaround play that worked out really well. So Danny, maybe the Intelligent Investor's one for you to go read, and then we can start doing some comments again. We've got some other stocks to talk about as well, though. But Google, I want to talk about Google because Google's been getting a lot of attention recently. Had a pretty good bounce up yesterday, and I think few people are starting to realise about AI. I think Google got wrote off because the AI was far behind the other kind of players in this space, like Microsoft, for example. And I think a few people are starting to actually realise that Google's AI platform is actually probably one of the better ones out there right now. And the thing with Google is, like, it's not a ridiculous valuation. I kind of wish I got the valuation up, but what is it, like 20 times forward earnings? 20 times forward earnings for an AI play. All the other kind of AI players here are like 30, 40, 50 times earnings. So with Google, you're kind of getting the AI platform for free. And people are kind of realizing, actually, this is a pretty good AI platform. The other thing is Waymo as well. Waymo has been, really starting to take a lot of talking points now, because people are realizing, actually, it's starting to scale up. It's being used in a lot of places. And if they keep doing this, they keep rolling it out to a lot of states, maybe then it gets into the UK, maybe it gets into China. This could be a very serious player. And once again, you look at Google, you kind of, with Google, you buy in the cloud and the YouTube and the advertising side of the business, and really you're getting all these kind of free bets inside the business. You're getting basically the AI part of the business for free, and that could easily be a multi-billion market cap company by itself. You're getting Waymo for free, and that could easily be a multi-billion market cap company by itself. And the likes of Uber's absolutely suffering massively because of this right now. People are looking and going, you know what, the problem is with Uber, like, it could be okay for like the next kind of 2 or 3 years, and Uber might do quite well. But as people seeing Waymo start scaling up, they're kind of realizing, thinking, hold on, the problem is that if it ever came down to the point of view where you have like Waymo and Uber in your city, and you could go get an Uber or Waymo to get to the location, the problem with Uber is that you're going to have to pay for a driver to get there. You go use Google and go use a self-driving car, them rides are going to be a lot cheaper. And the market's slowly kicking on, thinking, we've already started to get to a few places where that is kind of happening. And now you're looking and you're thinking, actually, it's getting more and more common, and it's having a bit of a tough time at the moment. And I think, if I was Uber, I'd be a little bit nervous about where the current direction is currently going at the moment. And I think that once again, it's just shouting out that, Google, you're getting all these kind of free bets with this business, and then you're looking at the valuation, and you're thinking, it's not bad at all. I think people are kind of looking past some of the DOJ issues at the moment and going, maybe Google's worth the pickup. And Uber, I think at the same time, I think a few Uber shareholders are kind of looking at that situation now, and it's crashing quite a bit, and a few people are getting a bit nervous about where the future of Uber might be in the next kind of 3 or 4 years. Another one that's doing quite well, Sofi, once again, absolutely smashing it. I think we're up 150% on Sofi now. Once again, this is kind of like what I was saying at the start of the video. The really big thing that I like about YouTube is that I get insights into the market and what retail investors are thinking. The other benefit is that sometimes I get so many stocks thrown at me, like in the comment section, like, go take a look at so-and-so, look at this, that most of the time now I hardly have to research any new businesses. Like, I just wait for some of you guys to kind of comment on YouTube videos or comment on the Discord, like, take a look at this stock, and then I'll have a look at it, and every so often, like 1 out of 10 eventually comes like, that's actually really interesting, and then I look at it and I go buy. So the great thing about this is that it really saves me finding stocks to research, because I get stocks thrown at me all the time that I research them. So it's like having a scouting network for me, which is great. The other thing is that, like I said, I get to see retail sentiment, and when I get to see what retail sentiment is, I can kind of see, okay, that's getting a little bit heated, or could there be an opportunity there? And Sofi was it. I remember making videos on Sofi a year ago. Nobody wanted to touch Sofi. Nobody was really talking about Sofi, but obviously I was here a year ago talking about it. And I'm making these videos talking about why I'm buying Sofi stock a year ago, and I had comments from Dividend Portfolio saying Sofi stock sucks, company itself is mediocre, Wall Street hate it, dilution will come, price target of $2 or $3, and then bankrupt. When you're getting those kind of comments like that, where people are coming out and saying the stock's going to go to $2 or $3 and it's going to potentially go bankrupt, that and it got quite a few likes as well. It was the most liked comment on that video. That gives me the good indication of where the sentiment is on when I'm doing those videos. And at that time I was like, okay, the stock's really slumping down. A year ago, back into the kind of, let me zoom out a little bit longer. Back in the 2013, really slumping down into the $5, $6, $7, and I was thinking, this is about, when nobody wants to own it, and the fundamentals are just getting better and better, because during that time frame, even though the share price wasn't performing, the financials were just getting better and better. The hike in the outlook, the profit was growing, the revenue was growing, and obviously bought it, and the stock's done amazing since that time frame, and it's should hopefully only continue as the fundamentals kind of continue to grow now. And that kind of leads me on to CVS Group. CVS Group was a stock that I posted about on Sunday, actually. And I posted about this stock, and same again, when I was talking about it, there's no positive comments on it. It's exactly the same on Watches of Switzerland. When I was buying Watches, no one wanted to own Watches of Switzerland, and then obviously did really well for me. You look at this stock here, nobody wants to own it. The stock's crashed 55%, and people are going, nope, still nowhere near a buy. And once again, that doing that video there and seeing such a negative response kind of gave me the confidence of going, okay, this is getting to maybe near the bottom now where nobody wants to touch it. It could be a very interesting time for it. Last one, Hollywood Bowl. So this is one of my largest UK holdings. Owned it for a long time. It's unfortunately year to date now, it's not had a great time because of the drop it did have, but before that it was actually doing quite well. But if we zoom out, it's a stock that I've had for a long time, since 2020, and it's done absolutely amazing for us. I've averaged up in that time frame, so I'm only up 60-70% on the stock. I even bought today, and so I keep making it larger and larger, but from a first buy I'm up over mega amounts on it. Bought the stock a little bit today on the drop, 14 times earnings, 4% dividend. In my opinion, one of the best run UK stocks out there on the stock market. Came out with an update, it's full year results. I actually thought the full year results were good. As far as I could tell, they were in line with expectations, I believe. And the outlook looked okay. And looking at the numbers, revenue was up 7.1%, adjusted EBIT was up 5.9%. There was a couple of impacts though on the profit before tax was down, and after tax was down 5 12%, but I think EBITDA was in line with expectations. As far as I'm aware, I knew profit was going to drop this year, so I'm surprised why the market kind of threw its toys out of the pram on these results. I don't believe it should have dropped, but it is what it is. The reason why it dropped, I probably don't want to start with that slide. I probably want to start with this one. So the reason why it dropped is there was obviously probably the drop in the profitability. They said that the employee cost rate went up 5 million. Obviously, the reason why is because there was a big increase in the national wage last year, and that's a big payment that they had to kind of pay out at the moment. There's the potential of the next impact coming in as well from another major increase in the national wage, minimum wage as well. But they said that they can cope with it, and maybe they just kind of put prices up. So maybe that made people a bit nervous, is that they saw a 5 million impact from the last increase, and with the new NI costs that are being slapped on them from the current government, maybe that's why people were getting a bit nervous. So there was a bit of an impact of 5 million. The other thing as well is, as we saw, this isn't even the current government, the last government before the one we had, the Conservatives, they hiked up corporation tax from 19% to 25% as well. So that was also another impact that they had at the moment. So yeah, it's been a tough time for UK economies. Obviously, not a great last government that hiked up a big increase in the tax, and then another increase of the minimum wage, and then obviously next year another hike up in the minimum wage and national insurance as well, which ain't great. But revenue still did very well. Up 7.1%. Another thing that did happen as well is that they did have an impairment impact of the mini golf centres, which was 5.3 million. Basically, they opened up some mini golf centres in 2020. They wanted to expand into mini golf. I was always a bit nervous about this because I just felt there was so much competition with the likes of Junkyard Golf, for example. I thought, I don't know if this is an area they want to go in, but you might as well try it. They tried it. They said that it hasn't really worked out as good as what they thought, and basically they said, we don't really want to continue opening up the mini golf centres because we make so much better money from the bowling centres. I'm fine with that. I'm fine with a business like that has the profitability of hold ball go, you know what, we're going to try something. They tried it for 3-4 years and they went, it's not worth doing it, let's just focus on the bowling. And there's been an impairment impact of 5.3 now. They're kind of going, let's just focus on the bowling. I'm fine with that. Like, shouldn't we be rewarding a business that's tried something, it didn't work out, and they went, you know what, let's stick with what we make the most money off. I think that's maybe what the market's punishing it off today. I call that good management, that they tried something and then they tried it for 3 years and they went, let's just focus on what we are good at. And what they're also really good at the moment is opening up more centres. There's going to be still the long-term target for financial year 2035 is 130 centres. And the big thing is, surely the big focus has to be on the Canada expansion, because we've seen how successful the UK business for bowling centres have been. Shouldn't we be looking at the Canadian expansion at the moment? And they can see here the big thing is that the Canadian business performed well. Total revenue increased another 42%, and the most important thing is like-for-like revenue also increased 6.3% as well. And we also had an increase in adjusted EBITDA as well by 2.1 million, which is great to see. So, once again, the kind of profitability from the Canada side of business is really increasing the profitability. I don't know why the market kind of got a little bit freaked out because of maybe the impacts of the corporation tax, which we knew were coming, and also that it had a one-off impact because of the golf business, and he went, we're going to focus on bowling. Probably the big thing that the market should have focused on is its profit driver for the next 10 years, which is its Canadian expansion, and that the Canadian expansion is going really well. I personally think the stock maybe should have been up today. I don't think it should have been down. I don't know why the market is throwing its toys out of the pram because of corporation tax that we knew was going to impact it a little bit this year, and wage impacts. I think it was all forecast. And maybe the big surprise was the golf business, but if it's not performing well and the management team have kind of cut it, I wouldn't really be punishing for it, because if I was looking at analysts, I'd be looking at the growth drivers for the next 3 or 5 years, and the growth driver that they've decided to focus on is the Canada business, and that's going really well. So I thought, okay, 10% is a bit too much for me. I'm going to buy the dip here on the Hollywood Ball. I think the earnings were still very good because the main expansion point is still going very well, and the fact that the management actually went, held their hands up and went, you know what, we might have got it wrong in the short term, but long term, with our main bet is actually doing really well, and that's what we're focused on. I like that. I think that's what the whole management team have always done. They've always executed really well, and it seems like they're getting the rewards. And it seems like once again a classic, the market impacting the stock because of short term profitability, rather than not thinking, well, they're focusing on the part of the business that's going to bring them in more revenue, more profitability in the long term. They're focusing on that, and they're getting rid of the part of the business that isn't doing that. Shouldn't you reward a management team that are doing those decisions rather than going, oh, we'll drag it out because we don't want the market to panic in the short term? You know, it's typical stock market short-term thinking for me here today. Is that, oh, we're going to throw our toys out the pram just because it's going to impact them in the next kind of 12 months, rather than actually thinking, oh, well, actually in the next 4 or 5 years, we're going to be really happy that they got rid of that lower profitability part of the business and focus on the high-end part of the business that's dragging more revenue and more profit. It's stupid, but that's what the market does. That's what the market does, as we've kind of explained in the whole video today. And I just would kind of go, okay, you want to give me that opportunity? I'm going to take it. And I did that. So yeah, that's the video for today, guys. Hope you enjoyed it. Thanks for watching. Hit the like button. See you in a bit.